In 2014, a 92-year-old man named Ronald Redd died in Brattleboro, Vermont. He'd spent his life as a gas station attendant and, later, a part-time janitor at JCPenney, never earning more than a modest hourly wage. When his will was read, his family discovered his estate was worth nearly $8 million. He left $6 million of it to his local library and hospital. 5 months earlier, a very different story had ended a few states south. Richard Fosconi, a Harvard-educated Merrill Lynch executive with an MBA, had retired in his 40s as a multimillionaire. He poured his fortune into an 18,000-square-foot Greenwich, Connecticut mansion that cost $90,000 a month just to maintain. The 2008 financial crisis left him bankrupt, and by 2014, that mansion sold at a foreclosure auction for a fraction of what it was worth. One man never set foot in college. The other had a Harvard MBA and 2 decades at one of the biggest names on Wall Street. One built a fortune from almost nothing, the other lost one. This video breaks down exactly what separated them. The real data-backed strategy that lets an ordinary beginner out-invest most trained professionals. And the biggest reason most people fail at investing isn't picking the wrong stock. It's something almost every new investor does without even realizing it. Stay to the end, because the last few minutes could matter more than any stock tip you'll ever hear. The problem: why most investors lose. Here's what almost nobody tells beginners. The biggest threat to your money isn't a crash, it's you. Dalbar, a financial research firm, has measured this for decades through its QAIB report. Over the 30 years ending in 2021, the S&P 500 returned 10.65% a year. The average equity mutual fund investor earned just 7.13%. That 3.52% annual gap sounds small until you see what it does over a lifetime. A potential $2 million nest egg shrinks to around $800,000. The cause is behavior, not bad luck. The average investor holds a mutual fund for only 4.19 years. Far short of the 5 to 7 years, markets typically need to recover from a downturn. Loss aversion explains why. Losing money feels roughly twice as painful as gaining the same amount feels good. So fear drives people to sell at the worst possible moment. Investors also tend to pile into an investment only after it's already surged, buying in right as the peak arrives. The opposite of buy low, sell high. October 2008 was the starkest example on record. In a single month, panicked investors underperformed the S&P 500 by 7.41%, locking in losses right before the market turned around. This isn't ancient history either. Even in the strong market of 2024, the average investor still trailed the index by 8.48%, one of the widest gaps of the past decade. The math. Why time beats. Timing corrections are part of the deal too. The market has dropped 10% or more 37 times since World War II, an average of once every 2.2 years, and it has recovered from every single one. So if it's not about avoiding drops or timing your entry, what actually works? Compound interest, and often called the 8th wonder of the world, a line reportedly traced back to Einstein, who said whoever understands it profits from it, and whoever doesn't ends up paying for it. Here's the mechanism. At the S&P 500's long-run average return of around 10%, money roughly doubles every 7.2 years. That's known as the Rule of 72. Time matters more than the amount you start with. A single $1,000 investment at age 20, growing at a steady 7.2%, becomes $32,000 by age 70. Wait until 30 to make that same investment, and it only reaches $16,000. Wait until 40, and it's just $8,000. The identical investment cut in half twice, purely from lost time. Grace Groner shows what that looks like over a full lifetime. Orphaned at 12, she worked as a secretary at Abbott Laboratories. In 1935, during the Great Depression, she bought 3 shares of Abbott stock for $180. She never sold a single share. She just reinvested every dividend and let the stock split for 75 straight years. When she died in 2010 at age 100, that $180 had grown into $7.2 million. Even bad timing barely matters over the long run. Capital Group tracked 2 investors who each put $10,000 a year into the S&P 500 for 20 years. One had perfect timing, buying at the lowest point every year. The other had the worst possible timing, buying at the highest point every single year. That unlucky investor still turned $200,000 into $801,554, a 12.64% annual return. Stretch the horizon out further and the risk nearly disappears. Since 1926, a rolling 20-year investment in the S&P 500 has never once lost money, and even the worst 20-year stretch on record still returned 1.89% a year. Time in the market builds wealth. Timing the market is a distraction. The solution: why simple beats smart. This is also why picking your own stocks is the wrong move for a beginner. S&P's SPIVA scorecard tracks actively managed funds against their benchmarks every year, and the results are consistent. Through 2024, 65% of active large-cap fund managers underperformed the S&P 500 in a single year. Over 10 years, that climbs to 84%. Over 15 years, it's above 90%. Full-time professionals, backed by research teams, still lose to a simple index most of the time. And the few who beat it rarely repeat the win. Of over 1,000 top-performing funds tracked, starting in 2015, only 43 were still in the top half 4 years later. The reason is cost. Actively managed funds typically charge 0.75% to 1.50% a year in fees. A basic S&P 500 index fund like Fidelity's FXAIX charges 0.015%. On a $10,000 investment, that's $1.50 a year instead of up to $150, a gap that compounds for decades. Funds like FXAIX or ETFs like Vanguard's VOO and VTI simply buy the entire market and hold it. A beginner who does nothing but put money into one of these funds already beats the majority of professional money managers for a fraction of the cost. The blueprint: automate it. The final piece is consistency, and nobody proved that better than Theodore Johnson. He joined UPS as a driver in 1924 and never earned more than $14,000 a year across his entire 28-year career. Early on, a friend convinced him to treat saving like a tax he couldn't avoid, automatically setting aside 20% of every paycheck to buy UPS stock. He kept that up for 28 years straight. When he retired in 1952, he held $700,000 in UPS stock. He left it invested for another 39 years, compounding at roughly 11.9% a year. By his death in 1991, that stock was worth $70 million, and he gave $36 million of it to fund scholarships. Here's how to copy that. Starting today, set up an automatic transfer from every paycheck into a low-cost S&P 500 index fund, timed for the moment you get paid, before you have a chance to spend it. If your employer offers a 401k match, claim the full match first, like it's free money, on top of a contribution limit of $23,500 a year as of 2025. After that, a Roth IRA lets your money grow completely tax-free, with tax-free withdrawals once you're 59 and a half, and the account has been open for 5 years. There's an old proverb: the best time to plant a tree was 20 years ago. The second best time is now. Automate one contribution today and let compounding handle the rest. If this changed how you think about investing, subscribe for more breakdowns built entirely on real data.